Thank you for joining me. I'm Juan, lead trader and founder of Prosperity Trade. In this quick short video, we're going to take a quick glance into the life of Michael Burry and why he's pinned up against Cathie Wood. You're going to want to watch this video. So Michael Burry, very well known because of the movie The Big Short. The Big Short, real face, played by Christian Bale. Michael Burry is actually on the right, born in New York, 1971. So Michael Burry founded Scion Capital, which he ran from 2000 until 2008 before closing the firm to focus on his own personal investments. He's actually a doctor and finished pre-med. He studied economics and pre-med at the University of California. He went to earn his MD from the Vanderbilt University School of Medicine and started but did not finish his residency in neurology at Stanford University Medical Center. At Scion Capital, he was extremely successful. Part of his style is understanding a company, understanding that it's overvalued, and shorting the company, making money by buying puts. If you take a look at his capital investment returns from 2000 to 2008, he beat the market every year pretty much, accumulating over 400% in net returns. For anyone who invested with him, made a ton of money. According to the author Michael Lewis, in his first full year, 2001, the S&P fell by 11.8%. Scion was up 55%. Michael Burry was able to achieve these returns by shorting overvalued tech stocks at the peak of the internet bubble. What does it mean to short a stock or to buy a put? So what Michael Burry would do, he would look at these tech companies, give them an intrinsic value based on their free cash flow, based off their revenue, based off the interest rate, based off of numerous things that would give them the value of a company, an intrinsic value, and there would be a big difference between what the stock was trading at, because you can be at a bull market, people are overpaying for tech stocks. So any small news, any or major news would cause people to be scared and get out of their positions. And that's usually what happens when a lot of companies are overvalued. Any bad news that comes, investors want to take their profits before the stock declines. He would find these companies and basically borrow shares from his broker and sell them up here. So if he borrowed one share up here, let's say at $20, he owes the broker one share. So when the stock price drops, he buys back that share at $10, let's say, keeps the $10 profit, and returns the one share to his broker. Why did they make a movie about Michael Burry? Well, there was a time in the early 2000s that everyone was qualifying for housing loans. They kind of like started giving loans to everyone and eased some of the restrictions, and people that shouldn't be getting loans were starting to get loans. And it gets a little bit deeper with smaller mortgage company banks selling to mid-sized loan companies to larger and buying loans in bulks. But that's a different topic. Basically, the people that should not have qualified for loans started getting loans, which caused a lot of property to increase in value. So what Burry did, he started focusing on a lot of these bad loans. And he predicted that there would be a market bubble, a real estate bubble in 2007. And it was actually 2008, so he was pretty close. He started betting against these loans by shorting the market. He persuaded Goldman Sachs and other investment firms to sell him credit default swaps against subprime deals, which he saw as vulnerable. And as the housing market crashed, he made millions and millions of dollars and made hundreds of millions of dollars for his investors. So Michael Burry has been extremely successful, and now he's starting to bet against ARKK, meaning buying puts against ARKK, the same way he shorted Tesla and other companies that Cathie Wood is heavily invested in. And that's why they've pinned them kind of Michael Burry versus Cathie Woods. Cathie Wood responded to Michael Burry's buying puts on ARKK, and she wrote in a tweet, to his credit, Michael Burry made a great call based on fundamentals and recognized the calamity brewing in the housing mortgage market. I do not believe that he understands the fundamentals that are creating explosive growth and investment opportunities in the innovation space. Cathie Wood has been criticized a lot, and many people point that the most successful trade she had was Tesla early on, but everything else has been kind of average. So this goes back to the growth versus value investor argument. I think that Michael Burry, he's extremely intelligent, has a great talent for finding these companies And the same way that a value investor finds companies that are undervalued and buying a company that is worth a dollar for 50 cents or 70 cents, Michael Burry has had success finding companies that are trading at $2 or $3 when they should be trading at a dollar, buying puts and making profit as the companies return back to their normal value. So Tesla is a company that he shorted, and many people truly believe in Tesla. They value it at $1,500. Some investors value it at $1,500. Some are extremely bullish and state that they're successful with everything that they are achieving or setting out to achieve, that it'll get to $3,000 per share. Now, the thing with this, they may be right, but when you go after growth stocks and that makes the majority of your portfolio, you're not putting yourself in the best position to be successful because you're betting on a lot of things going right. So Tesla, for example, if they crash, have multiple accidents with their self-driving vehicles, if another competitor comes out with cheaper batteries and is able to sell something that is equal to Tesla for a lot cheaper, Tesla's going to go down in value. That's kind of the thing. It's hard to find multiple growth stocks, especially like with the pharmaceutical space and genomics and new technology. All these things can have bad results. We talked about FBRX, where that stock crashed 80% because they failed to get FDA approval for one of their medications or one of their few and only medications. So what a value investor does, they put themselves in the best position to win. They pick stocks that they see undervalued, and if they do this 10 times, more than likely they're going to be profitable, because even if that stock price drops, they already bought it at a deep discount. So as long as they continue to hold, they believe that it'll get back to its normal value. Thank you for joining me. We hope to see you in the next video. Please don't forget to subscribe, comment.